Assalamu alaikum wa rahmatullahi ta'ala wa barakatuh. The cornerstone principle of financial dealings in Islam is highlighted in Surah Al-Ma'idah, verse 2, that individuals should not consume the wealth of others unjustly, but rather engage in fair and just trade based on mutual consent, so as to cooperate with one another in goodness and righteousness. With such principle in mind, the Shariah encourages people, as mentioned in Surah Al-Jum'ah, verse 10, to go about and seek the bounties of Allah Azza wa Jal and engage in trade activities. Fortunately, such an expedition does not entail that we must expose ourselves to precarious transactions without taking reasonable and precautionary measures to mitigate the risks. Now, in order for market players and business entities, which include investors, corporations, public sector agencies, to protect themselves against the potential financial risks, they must first understand them. As so, let's run through some of the prevalent financial risks that business entities are exposed to. Upon doing so, we'll discuss some of the key countermeasures that one ought to take in order to mitigate them. Firstly, credit risk. Simply put, it is the risk of a debtor defaulting in payment, meaning failing to honor a debt that is due. For example, in a murabaha contract, which is a markup sale, the financier expects the customer, who is a debtor, to make periodic payments on specified dates. But of course, there is the possibility that the customer would not make the payment on time for whatever reason. Hence, in the contract of murabaha, the financier is exposed to a credit risk. Next, market risk. These are risks associated with factors beyond market players and those that have an impact on the economy. They're divided into two types: systemic or systematic risk, and specific or unsystematic risk. Now, the first kind, systemic or systematic risk, is a risk that affects most or all markets. In other words, the economy as a whole. Examples of these include changes in oil price, currency fluctuation, known as currency risk, natural disasters, and civil war, known as political risk. Specific risks, on the other hand, are those that affect specific industries or companies. So, for example, Pakistan's intent to eliminate riba from its banking system by 2028 would surely have an impact on its financial sector. Now, in addition to credit and market risk, we have what is known as operational or business risk, which in contrast to market risk, relates to factors within business entities. Hence, they are business decisions that hinder a company's profits or cause it to suffer losses. For instance, a drop in value of a company or an investment may occur due to one of many reasons. It may be due to the management's poor market analysis or prediction of the market, which is referred to as strategic risk. It may be due to a market player's failure to comply with a particular law or policy, which is referred to as legal or compliance risk. Now, it may also be due to a market player being caught engaging in unethical behaviors or practices that result in lofty sanctions being imposed and the customer base shrinking. This is obviously a reputational risk. Now, there are other kinds of business operational risk, but I believe you get the point. So let's move on, because we need to talk about liquidity risk, which occurs when a business entity is unable to convert its illiquid assets into liquid assets fast enough to pay off its dues or make up for serious losses. Now, this is caused either due to internal issues like poor management of resources or external factors like a market decline. Lastly, we have Sharia risk, which is particularly relevant to players in the Islamic finance industry. It is the risk of a market player's financial activity or product not complying with the applicable Sharia rulings. Now, one would ask, what could potentially happen when a Sharia risk materializes? Now, to answer that, we may go back to 2007, when the renowned Sheikh Mufti Muhammad Taqi Uthmani, who is the chairman of IOFI, declared that the overwhelming majority of sukuk issuances that were non-lease based were Sharia non-compliant. Now, his rationale for such a huge statement was that most sukuk were asset-based and not asset-backed, which entails that in case the buyer or the obliger defaults in payment, the sukuk holders would only have a legal claim against the buyer, but they would not have any claim over the underlying sukuk assets. This bold declaration of Sheikh Muhammad Taqi Uthmani is said to have disrupted the global sukuk market, plummeting its size from over 30 billion USD to a humble 1.4 billion USD. This is one example of a Sharia risk manifesting itself. Now, having covered a number of key financial risks that market players, particularly those within the Islamic finance industry, ought to be cognizant of, we'll delve into the kind of measures that may be adopted to mitigate their undesirable effects in the next episode. So stay tuned and remember to follow Adil Advisory. Until then, Assalamu alaikum wa rahmatullahi wa barakatuh.